The first part of this video is going to summarize some basic information about the cash flow statement. Out of all the major financial statements, the cash flow statement is the youngest. Even nowadays, it's still not given the attention it deserves, often being left to the last chapters of financial accounting course books despite its importance. It's mainly used to assess the liquidity of a business, meaning its ability to pay its bills. A cash flow can be classified in one of the following categories. Number one would be operating activities. A cash inflow in operating activities would be cash received from sales of goods and services to guests, for example, while a cash outflow would be cash paid to employees for salary and wages. Next, we have the investing activities. Here, an example of a cash inflow would be cash received from sales of property and equipment, while a cash outflow would be cash paid to purchase property and equipment. Lastly, we have the financing activities. Here, a cash inflow would be, for example, cash received from sales of capital stock, while cash paid to reacquire capital stock would be a cash outflow. There's two methods one can use to construct a cash flow statement. The first method is the direct method. This one requires a supplemental schedule, and the net income is reconstructed on a cash basis. This method is used by 2.5% of companies. The second method is the indirect method. It does not require a supplemental schedule, but it can be added for completeness' sake. The net income is reconciled to cash flow from operating activities. It is used by 97.5% of companies. Lastly, preparing the cash flow statement is done in a four-step process. The first step is to determine the net cash flows from operating activities. The second step is to determine net cash flows from investing activities. The third step is to determine net cash flows from financing activities. Lastly, in the fourth step, the cash flows are presented by activity on the cash flow statement. The second part provides summarized information about the analysis and interpretation of financial statements. Financial statements are used to answer questions such as the following. Is there sufficient cash to meet the establishment's obligations for a given time period? Are the profits of the operation reasonable? Is the establishment able to service its debts? Is the inventory usage adequate? And many others. There are several types of analysis one can use to analyze the various financial statements. The first one is the horizontal analysis. It calculates dollar and percent changes for two accounting periods. Statements using horizontal analysis are also called comparative statements. The second one is vertical analysis. It reduces balance sheets and income statements to percentages. Statements using this analysis are also called common size statements. The third one is the trend analysis. It's useful for analyzing financial information over several time periods, generally years, and reflects changes over time. The last one is the ratio analysis. It expresses logical relationships between certain items in the financial statements. The first example is the current ratio. It compares total current assets to total current liabilities from a single financial statement, the balance sheet in this case. Another ratio would be accounts receivable turnover. This compares the average accounts receivable from the balance sheet to total sales from the income statements. Ratios are generally classified by the type of information they provide. Liquidity ratio, solvency ratio, activity ratio, profitability ratio, and operating ratio. This concludes the summary of the presentation this video was done for. Thank you for your attention.